Assalamualaikum warahmatullahi wabarakatuh. We are now in our second video of this chapter 7. We will discuss on account receivable. Okay. Receivables are claims held against customer and others for money or for money, goods or services. So receivable actually is that we as the company have claim on other parties, that is our customer, for money, goods or services that they have to pay to us. And there are two types of receivable. First one is oral promises. Since it is oral promises, we call it not account receivable. And the second one is written promises. It is written, so it is called also as notes receivable. Okay, and then the first one of account receivable is the non-trades receivable. It could be in the form of advances to officers and employees, like in the cash before. This receivable does not relate to trading of the company does, but it is a non-trade related event, such as the first one is the advances to officers and employees, for example, for their travel purposes. And the second one is advances to subsidiaries. It is our receivable to our subsidiaries, and deposit paid to cover potential damage and losses, such as insurance, and then deposit paid as guarantee of performance of or payment. And also dividends and interest receivable, and also some claims against insurance companies, defendants under suit, for example, governmental bodies for tax refund, and so on. So those non-trade receivables are receivables that is not related to operating activities of the company, or it is not related to trading. This is the examples of how the company reports on the non-trade receivables. For example, Heineken put all receivable, whether it is trade and other receivable or non-trade receivable, into one account. It is called here trade and other receivable, while Nokia only disclose account receivable alone. The first activity relates to accounting is recognition of an event. So in the case of account receivable, the recognition relates to it generally arises as part of revenue arrangement. So account receivable always relates to revenue activity or revenue generating activity or revenue arrangement here. Then the question is, when do the company recognize an account receivable? So based on this arrangement, then it indicates that the company or we as the accountant must recognize revenue when it satisfies the performance obligation by transferring the good or service to the customer. Here it means that we recognize account receivable when we can, or we also can recognize revenue. When do we recognize revenue? It is when we satisfy or we meet the performance obligation. For example, when we sell our goods, and it is said that the good must be transferred from our store or our what is it? Yeah, let's say from our store to their stores, and when the and the and the and the term said that the the company will recognize revenue when the goods or the products is arrived or has arrived at the buyer's store. So when the company recognize revenue, it is the time also for the company to recognize account receivable. So for example, here Lululemon Athletica Incorporated from Canada sells a yoga outfit to Jennifer Burian for 100 on account. On account means on credit. The yoga outfit is transferred when Jennifer obtains control of this outfit. It is when the arrangement is finished, or when obligation has been transferred from Lululemon to Jennifer Burian. When this change in control occurs, Lululemon recognizes the account receivable and sales revenue. So the critical event is when the change in control occurs. So it is when the account receivable and sales revenue can be recognized. So the entry will be account receivable on debit and sales revenue on credit, as much as $100. So you see here account receivable in debit. It means that the assets is increased by 100, and the sales revenue in credit, it means that sales revenue increase also as much as 100. Sorry. There are some indicators that Lululemon has transferred and Jennifer has obtained control of the yoga outfit. First one, that Lululemon has the right to payment from customer, because the yoga outfit has already on the hand of Jennifer. And then second, Lululemon has passed legal title to the customer. So the ownership of the asset has already been on the customer. And the third one, Lululemon has transferred physical possession of the goods. Of course, it is already on Jennifer's hand. And the fourth, Lululemon no longer has significant risks and rewards of the ownership of the good. So Lululemon cannot have any other benefit from the goods, since it is already owned or under control of Jennifer. The last one, Jennifer has accepted the assets. So when we recognize, we need to measure the transaction price. So the transaction price is the amount that the company expects to receive from a customer in exchange of the transferring of goods and services. So let me give you here the perspective of this transaction. Here the seller is the company, and then customer or the buyer, buyer. Okay. So the company send goods to customers, and I make it dash here. The customer will send some money. The question is, when the customer will send the money, and how much the money will be sent, and how possible the money will be received. It means that if, where's the cursor? I cannot see the cursor. So here, if the money if the goods were, let's say, $100, will the money also 100 or below 100? So it is the question here when we measure the transaction price, because we expect to receive from a customer. So the variable consideration that we need to consider here is the price of the goods or service is dependent on future event in some cases. So these future events could be discount, returns and allowance, rebate, and performance bonuses. For example, there are trade discount. Trade discount is actually a discount that is given to customer without alter or change the price. So, for example, here the price, the advertisement said that 10% discount for new retail store customer. It means that the price is still, let's say, 100, but since you are the new customer, you are given 10% of discount. This is what we call trade discount. And the second one is cash discount, or called sales discount. It is ordered us to induce prompt payment. So as we mentioned before, that receivable, the variable that we need to consider in account receivable or any receivable is when do we receive the payment from our customer. So to induce or to pursue customer to pay quickly or earlier, we need to give some inducement. It is in the form of cash discount. This cash discount, for example, is 2 by 10 net 30. It is 2 by 10 or 2 by 10 net in 30. It means that you will be given 2% of cash discount if you pay in 10 days after your purchase, and all of your receivable or all of your payable must be paid within 30 days. This is what we call here 2 per 10 and net in 30. There are two types of accounting here. The first one is gross method and the second one is the net method. Let me show you these two methods here. So the gross method. Okay. So the gross method and the net method is different when we, So when we use gross method, I want you to focus on this account receivable here and account receivable here. You see that when we use gross method, the account receivable here the sales is 10,000 euros term 2 per 10 net in 30. So we recognize or we write our journal here account receivable of 10,000. Means that if we make have the account here of account receivable, here we have $10,000, while when we use net method, we only has or we only recognize 1,800. Why we use different number? Because of this discount. So 2% or equals to 2%, it is assumed that this 2% will be taken by our customer. So this 200 euros will be taken. So if you use net method, we write down 9,800. And when we let's say when we have payment of 4,000 here, it means that the corporation or our buyer receive a discount of 2%, 2% of 4,000. So it is equals to $80, 80 euros. So we only record sales here. We record sales as much as we only record cash here. So cash was only 3,920, right? And we have sales discount as much as 80 euros. So you look at here, and we credit our account receivable of 4,000. While when we use net method, our account receivable deducted as much as 3,922, as much as the cash that we receive. You look at this, okay? And then the other payment of 6,000, and it is received, the payment is received after the discount period. So our remaining account receivable is only $6,000. So we have cash of $6,000. But using the net method, you look at here, we also receive cash as much as 6,000, but our account receivable we only receive as much as 880, while the other 120 is what they call it sales discount forfeited, or that is not being used. So when you sum up this one, it equals to 9,800. While when you use a gross method, the account receivable is 10,000, while here the account receivable only 9,800. So but the difference of 80 euros is went to this sales discount. So we have sales discount here to record as the differences between both. So you can see now that when we use gross method, the differences between those two methods is that we in gross method we record account receivable as the amount of the sales that we record with our customer. But when we use net method, the account receivable recorded or the sales revenue recorded is assumed to be 98% of our sales, because we assume that this 2%, this discount, will be used or will be taken by our customer. It is only assumed, not really being used, but it is assumed. So here you can see that the differences between both of this method. But in many companies, most of the companies use gross method instead of net method, because when we use this net method, some sales discount that is not being used will come up here and will be put as a kind of loss to the corporation. So it is much more, this gross method is much more used than the net method. And then the next is sales return and allowance. Sales return and allowance, it is only a contra revenue account to sales revenue. So by saying that it is a contra revenue, it means that it will deduct our sales revenue. While sales allowance for sales return and allowance is a contra account to account receivable. So this is the example that Max Glass sells Hurricane Glass to Oliver Builder. As part of the sales arrangement agreement, Max includes a provision that if Oliver is dissatisfied with the product, Max will grant an allowance on the sales price or agree to take the product back. On January 4, 2019, Max sells 5,000 of Hurricane Glass to Oliver on account. So Max records the sales on account as follows: account receivable of 6,000 and sales revenue of 5,000 and sales revenue of 5,000. Let me see whether I have this one here. Okay. So you can see that we debit account receivable as much as 5,000 and sales revenue as much as 5,000. And then 12 days after the sales, Max grants an allowance of 300 to Oliver because of some of Hurricane Glass is defective. So the entry will be sales return and allowance of 300 and account receivable of 300. So when we make a T account, so the T account will be like this. This one is sales 5,000. This is the first information that we have here. Sales revenue is 5,000 here. And then there is an allowance, sales returns and allowance. So we have sales return and allowance here. Sales return and allowance here as much as 300. So it is called contra account. This sales return, it is called contra account because it will deduct the sales with this account. So in presentation in the statement of financial position, if we have sales here of 5,000, then we will have sales return as much as 300. Sorry, 300 here. So the net sales will be 4,700 net sales. So it is what we call here as sales return. On January 31, before preparing financial statement, Max estimate an additional 1,000 in sales return and allowance will result from the sale to Oliver on January 4. And adjusting entry is coded in the okay. So we make an additional of sales return allowance of 100 and some allowance for sales return and allowance of 100. And then we come to time value of money. This is this topic is covered in chapter 6 that we do not discuss because it is already been discussed in mathematical for business. So the time value of money is a topic that assume that any revenue after the period of sale is the interest revenue. Here in this order, this time value is money is ignored in the interest that the company may receive because the concept of time value of money is ignored here because it is usually it is not material in relation to net income for the period. So that is all. And then this account receivable, this is how account receivable is presented in the statement of financial position. I think we may speed up here. You can check. Actually, you can check on actual annual report of Indonesian Corporation of how they present account receivable. Okay, this one where account receivable is separated with allowance for doubtful accounts, and this is where they only present it in one row. So now we come to valuation of account receivable. After we recognize the account receivable, then we come to the valuation of this account receivable. And when we value our account receivable, we must admit or we must believe that some of our account receivable will not be collected. Why our receivable will not be collected? It could be because that our customer was in bankruptcy, or our customer ran away with our money, or anything else, so that our money will not be, or our receivable will not be collected. And because of this because of this possibility, we must record some bad debt expenses or uncollectible account expenses in our book. There are two methods of how we account for uncollectible amount. The first one is direct write-off method, and the second one is the allowance method. The direct write-off method is the method where we directly write off the account receivable when we are sure we have some when we are 100% sure that our receivable cannot be collected anymore. But this method is theoretically deficient because we will not record expenses as the expenses incurred. And the second one, receivable not stated at the cash realizable value and not appropriate when the amount is, uncollectible is material. So let me show you why it is not deficient theoretically here. Let's say this. Okay. Let us assume that here is the time. This is 2019 and this one is 2020. When here we have the sales in 2019, we have the sales and let's say 100 million rupees, and here we expect, and those all sales are on credit, so we have our account receivable here as much as $100 million. So this one happened in 2019, and then during this period, let's say we expect that all the money will be collected in 2020. So in 2020, we find that 10% of our receivable of 100 million cannot be collected. So it is equal to 10 million rupees. So this 10 million rupees cannot be collected in 2020, while the sales was made on 2019. So this 10,000 should have been debited as expenses, or should have been expense in 2019. But since we use direct method, or when we use direct method, the expense is recorded in 2020. So if we record these expenses in 2019, the net income in 2019 should have been lower by 10 million rupees. But since if we use a direct method, and then this 2020's net income will be undervalued as much as 10 million rupees. So it is theoretically flawed if we use direct method, because we fail to record expenses as it is incurred. So, but when we use allowance method, and this is the method that widely used, loss are estimated based on percentage of sales or based on percentage of receivables. And also, IFRS, an Indonesian's accounting standard, requires that when bad debts are material in amount, we must use allowance method. So we may use direct write-off method only when it is not material in amount. So this is the example of direct write-off method. Assume that on December 10, Cruise Limited writes off an uncollectible USADO's account receivable as much as 8 million dollars. So the entry will be bad debt expenses and account receivable of USADO. So you look here, expenses is recorded. Expenses is in debit as much as 8 million, and then account receivable is credited as much as 8 million. So this is the direct write-off, and then the second method is allowance method for uncollectible accounts. So we need here first we need to estimate how much of the account receivable that will not be collectible at the end of each period. To do this, we need to estimate our uncollectible. For example, here, this is the example. Assume that Brown Furniture in 2019, its first years of operation, has credit sales of 1.8 million pounds sterling. Of this amount, 150 pounds sterling remains uncollected at December 31. So at December 31, 150 will not be collected. It's estimated to be not collected. The credit manager estimated 10,000 of these sales will be uncollectible. The adjusting entries to record the estimated uncollectible, assuming that there is zero balance in the allowance, is this. So bad debt expenses is 10,000, and allowance for bad doubtful account is 10,000 in credit. It means this position means it is in debit. This position means credit. Okay. So the amount of 140 represent the cash receivable value of the account receivable at the statement date. So we look here, account receivable of 150. Okay, 150 is the number the company the amount of account receivable that has not been collected. Of this 150, 10,000 will not be collected. So 140 represent the cash receivable value, cash realizable value. Cash realizable value is the value that the company expect to realize in the form of cash at the end of as of the date of this final statement of financial position. And how do we record the write-off of an uncollectible account? The write-off can only be made on when we use this method is when the company has used all the means to collect the account receivable. This is the example. The financial vice president of Brown Furniture authorized a write-off of 1,000. This one, the financial vice president write-off of 1,000 balance out by Randall PLC on March 1. The entry will be, so the allowance is allowance for doubtful account is 1,000 and account receivable deducted as much as 10,000. So if you can recall that when we have our account receivable in debit, let's say the amount is XXX, and then at the end of the year we made some allowance for bad debt account. So let's say we have made allowance of let's say $3,000. So or the balance is $10,000, and we made some bad debt expenses here. Bad debt expenses here. So bad debt expenses here, let's say we made as much as $100. So this is balance. This is the balance, not the amount of expenses here. Let's say we have I'm sorry. And expense is 100 here. Let's say we have another 100 here, so the balance is 3,100 here. This one happens in December 31. So this one is only December 31. Let's say this here is in March, so the write-off is 1,000. So to write it off, we do not need to make a bad to record expenses anymore, but we come to allowance for bad debt as much as March 1 as 1,000. So debited as much as 1,000, and we deduct our account receivable as much as 1,000 on March 1. So March 1. So you can see here that we deduct our account receivable as much as 1,000. And then assume that on July 1, Randall pays the 1,000. So it turns out that the Randall can pay the 1,000 of the receivable that has been deleted. So we made some new entry here. We record back our account receivable of 1,000 here on June. We record it back of 1,000, and we deduct our allowance back with how do we use it here? Now let's say here another 1,000 to be added back to our allowance for bad debt account. So, and then we record cash as much as the money that we receive, and we record back our net account receivable, but just to credit it. So we credit again here. So on July 1, there are two entries for our account receivable. First one, when we record our account receivable here, when we record our account receivable back, and when we credit it back since we receive some cash here. I hope that this will help you to understand this topic. Okay, so and then how do we estimate the question? The next question is, how do we estimate our allowance? The first one, by using a percentage of receivable approach. This one, to do this estimation, we need to have the amount of our receivable could be by composite rate. It means that we use a certain number for all receivable, or by using aging schedule. This is the example of when we use aging schedule. When we use aging schedule, here you can see that this is the amount of money, the amount of account receivable, the balance in December 31. There are 4 customers. Western Stainless Steel has account receivable of 98,000, and so Brockway and Freeport and Allegheny, so on. So the amount was $547,000 euros. So using aging schedule, we divide our the life of our receivable into some groups. For example, under 30 days and more than 30 to 60 days, more than 61 to 90 days, and 91 to 120 days, and over 120 days. Let's say that Western Stainless Steel only has 2 groups of receivables based on aging schedules. Brockway Western has 3, Brockway has 2, Freeport has 1, but it is already over 120 days. So the amount of these groups must be equal to 547. So based on experience, that if the account receivable under 30 days, as much as 347, percentage of uncollectible will only be 0.8%. So the balance only needed to be 0.08% times 345. It equals to 2,760 euros. Between 30 to 60 days, 400%. Between 61 to 90 days, 15%. And the last one, over 120 days, 25%. So the amount is the total balance for allowance, balance in allowance should be 26,610 euros. So the bad debt expenses for 2019, let's say, must be 26,610 $10. So we have here bad debt expenses of 26,610, while the allowance was allowance for bad debt account equals to 26,610. It is assumed that there is no balance before this, so or the balance was 0. what will happen if the balance was not zero? Let's say here, okay, let us go back to our presentation. So this is when it was zero, but when the account was not zero, so okay, so when the account was not zero, let's say that there is a credit balance of 800 before the adjustment, and we need to make allowance of 26,610, then we only record as much as 26,810. So let's say we already has 800 here, as let's say that we have, let's say we have 800 here as balance, not zero but 800 as balance. So and we need to have 26,610, and then we only need 28,810 as our bad debt expenses. So it is why in our slides here, we only need to record bad debt expenses as much as 27,810. The next illustration that Duncan SE report the following financial information: account receivable 100,000, allowance for that doubtful accounts 2,000, sales revenue all in credit is 900, and sales return allowance 50,000. So prepare the journal entry to record bad debt expenses, assuming that Duncan estimate bad debts at 5% of account receivable. So 5% based on all the account receivable. So based on this number, 100,000 number, and 500% of accounts receivable, but allowance for the full account has 1,500. So if we base on account receivable 500, it means 5%, it means we have 5,000 here, but 100, and there are on debit balance of 1,500. So let us here, you see here, we have, okay, we have here. So to record our bad debt expenses based on the first instruction, point A, we record bad debt expenses as much as bad debt expenses as much as 3,000, and allowance as much as 3,000. So you see here, we do not deduct our account receivable. We do not deduct our account receivable, but we create allowance. So we create allowance here, okay? And the instruction B need us to record our account allowance if there is 1,500 in the bid account. So if we have 1,500 in the bid account, it means that we have here 1,800, while we need to have 5,000 here. We need to have 5,000 here We need to have 5,000 here, 5,000 here. So we need to have, so to have 5,000 we need 6,000, we need, how much was it? 6,500. 6,500. So we need 6,500. So that the delta will be 5,000. So the delta is 5,000. 5,000. So it is all for notes receivable. Next, we will discuss notes receivable in the third video. So see you again on the next video. Assalamualaikum warahmatullahi wabarakatuh.